Good afternoon, Guy.
Good afternoon.
Not much change on the economic horizon, unfortunately. The energy crisis, economic tensions from the war in Ukraine. The side effects are really starting to have a tangible impact, not to mention the impact of resumed public spending in a post-COVID world. Many are predicting a period of recession in the world economy. What are your thoughts?
Yeah, my thoughts are, and you already mentioned all the factors that are weighing on the world economy currently. So I think you see more and more signs of a slowdown in the world economy. Whether we'll go as far as a recession, we'll have to see. You could see technically the US is already in a recession because a recession is defined as 2 following quarters of declining GDP. The first quarter we had a decline in the US GDP. Second quarter we should have a decline too. We know that by the end of this month. So from that point of view, you could say that technically the US is already in a recession. But more fundamentally, I think, because of all the factors that you were mentioning, clearly the outlook for world growth has deteriorated quite a bit.
Okay. And added to this, the political crisis in Italy. This adds more negative factors into the mix.
Yes, it's certainly not a positive factor, although I would say it's more a factor for the Eurozone, much more than for the world economy. Clearly, what the situation also shows again is these construction flaws. From construction flaws when it comes to the euro, which again are coming to light nowadays in an environment where interest rates are increasing.
Okay. Yeah, and inflation has been a hot topic since the start of the year. The central banks and governments have implemented measures to deal with this situation. Do you think that they're enough to deal with inflationary pressures?
I think we could see a cyclical decline in inflation in the coming months, in the sense that if world growth is really slowing down, then it would be logical to assume that inflation will come down also a little bit. And then we've seen quite a sharp decline in commodity prices recently because of these recession fears. So from that point of view, from that point of view, inflation should decline a little bit. But I think one has to make the distinction between a cyclical decline in inflation and on the other hand, a situation where the structural ongoing inflationary pressures will remain quite high.
Yeah. And then the 21st of July saw the ECB deciding to raise interest rates by 0.5%. Is this a good thing?
Yeah, it's a good thing in the sense that we had this absurd situation where the inflation rate in the Eurozone was around 8.6, or is around 8.6%, and the European Central Bank still had a negative interest rate. So that clearly was completely absurd, and now this increase is obviously a good thing when it comes to fighting inflation.
Okay. We've also often talked about the US Federal Reserve's lack of action. And in the past few weeks, it seems that they've been making up for lost time. What do you think about that?
Yes, it's clearly changed their attitude completely. Last year, they told us that the rise in inflation was only temporary, and there was no need for them to really fight it in an aggressive way. And then starting at the end of last year, beginning of this year, they completely changed their point of view, and now they clearly want to fight inflation, and they started to raise interest rates in a much more aggressive way. I think to a certain degree, it's a good thing longer term, because if that means that the inflationary pressures, we can get them out of the system again, then it will be a good thing. But clearly in the short run, it's not a very good thing for financial markets.
No, and they're clearly under pressure. Inflation, rising interest rates, economic slowdown, fears of recession, central banks changing policy. There's a lot on the table right now. How can we keep optimistic?
Yeah, clearly one has to be aware that at least in the short run, the environment for financial market has deteriorated quite a bit. We have a situation where there are signs that the economy will slow down, so that's not particularly good for company earnings, so not very good for equities. And on the other hand, we have central banks who now want to fight inflation in an aggressive way, which normally means that they will continue to raise their interest rates. So from both fronts, company earnings and interest rates, the situation right now for the equity markets is not very good.
Yeah. The euro has never been as low against the dollar and other currencies. Should we be concerned?
I think the weakness of the euro this year reflects the market's doubt about the willingness of the European Central Bank to really fight inflation in a very aggressive way, because the market says if the ECB raises interest rates in a very aggressive way, a little bit like the Fed does, then we'll get this fragmentation. So the increase again in the interest rate differential between the north and the south, that will create problems for the south, and again then we have this construction flaws from the euro. So from that point of view, the market thinks that in the end, the priority for the European Central Bank will be to make sure that the euro survives. If that means that inflation will be higher, then the European Central Bank will accept that, and that obviously makes the euro, at least for the moment, a weak currency.
Yeah. And what could reverse this trend?
I think what can reverse this is if the European Central Bank can incredibly show the markets that it means business when it comes to the fight against inflation, and with the interest rate rise of increase of 50 basis points on July the 21st, that's a step in the right direction.
Okay. And the price of raw materials is a closely scrutinized indicator. Should we expect the trend to turn around after the spike of the past few months?
Yes, as I said before, we've already seen a decline in the price of a lot of commodities, and that's due to this idea that the growth will slow down, and so that the demand for commodities will slow down. But again, I think it's a cyclical decline. Longer term, you have this problem, this mismatch between supply and demand when it comes to most commodities. So we supply will not be able to increase enough in the coming years, and that should lead to higher commodity prices once demand gets stronger again. Okay.
And will the situation in the US dictate the situation for the rest of the world in the coming months?
Yes, US is still to a certain degree the main growth engine for the world economy. So from that point of view, a sharp slowdown in the US economy obviously would have a lot of repercussions on the rest of the world. Even more so since the other growth engine, i.e. the Chinese economy, right now doesn't show a lot of signs of really accelerating very strongly. So from that point of view, it would have repercussions for the rest of the world. But I think the recession risk to a certain degree is bigger in the Eurozone, because we are a net importer of energy, and obviously the energy situation makes for a very critical element.
So yeah, there doesn't seem to be much reason to be optimistic about other regions in the world then.
I think generally we still, even though there's this trend going back from globalization, but we still live in a very globalized world. So again, there's no way around the fact that a major slowdown in the US economy will have repercussions for the rest of the world. That being said, I think there are regions, especially Asia, which over the last years has maybe shown more orthodoxy when it comes to monetary and fiscal policy, and I think their longer-term outlook remains quite favorable.
Okay. The financial markets are suffering, so do you think there's a crash on the horizon?
Yeah, crash again is such a big word.
Yeah.
Crash normally happens when something completely unexpected happens. Now I think what we're seeing is as we said before, the deterioration in the outlook for financial market, but the factors are known. So a crash would be a little bit surprising, but a further decline in equity prices seems clearly a very realistic possibility. Yeah.
Okay. And then whenever the markets are down, it seems to renew investor interest in the markets. So is this the right time to invest?
No, I don't think that this is already when it comes to the market in general, I don't think that this is already a huge buying opportunity, especially not for the European and US markets. Again, the correction this year has been somewhere between 10 and 20%, but that's when compared to the highs of end of last year, but the market is still quite high compared to where it was 2 years ago, 3 years or 4 years ago. So it's not as if valuations were particularly cheap. That's not clearly not the case. So from that point of view, I wouldn't see this correction, at least for the moment, as a big buying opportunity.
Okay. And in the last edition of Perspectives, you were talking about the paradox between analysts who are expecting corporate earnings to rise, and then the reality on the ground, which seems to be out of sync with the consensus. How do you explain this mismatch?
Yeah, it's normally the analysts' expectations often prove to be too optimistic. But in this particular situation, what I find a little bit surprising is that analysts seem to think that earnings will still increase quite a bit in this year and next year, even though when you look at the environment, you see that there's more inflation. So from that point of view, costs for a lot of companies are increasing. So that should lead it for most of them to lower profit margins. So in such an environment, it's a little bit surprising then to expect earnings to increase a lot. So that would then mean that sales would increase enormously if company margins are coming back, and sales, if we see already the first signs of a slowdown in the world economy, it would also be surprising that to see a lot of sales growth for most companies. So from that point of view, also given the fact that company earnings have already been very strong at the end of 2020 and last year, so they already are at quite high levels. So to assume that starting from these levels, you will see a lot of earnings growth for the market in general for the next 2 years seems a little bit optimistic.
Yeah, so what do you recommend for investors who are still hesitating? What's the safest approach and what's the least risky approach?
Yeah, it depends always on how one defines risk and safety, in the sense that clearly I suppose one should expect volatility to remain quite high on the financial markets, especially on the equity market. So an investor who cannot live with this type of volatility should be prepared, maybe not then to invest in equities right now, or even bonds for that matter. On the other hand, I think the medium or long-term objective for an investor should be to defend his capital and his purchasing power, so adjusted for inflation, to make sure that the value of his capital adjusted for inflation remains at least stable, and if possible increases. And I think the equities, or let's put it this way, stocks from good quality companies are still the best way to achieve that objective.
Okay. And our final question, as usual, is about gold. So prices seem to be hemmed in or dragged down by the impact of US monetary policy. Do we need to move away from this investment?
Yeah, well, here too, with gold too, there's a difference between the short-term and the medium to long-term outlook. Short-term outlook, you already said it, in an environment of rising interest rates, a strong dollar, that's usually two things that are not particularly good for gold. Gold doesn't pay any interest rate, so if interest rates increase, then obviously gold is at a disadvantage. And as long as this situation endures, I think it would be unrealistic to assume that gold price will start again to appreciate very strongly. Medium to long term, I don't think that the central banks will be able to normalize their policies. I don't think that the rise in interest rates can go very far, because we still have all these problems with debt. We have a lot of debt in the world economy. We have a lot of risks in the financial markets. So if interest rates rise too much and too rapidly, there will be problems. And then Federal Reserve, but also central banks in general, then again have to change course. And so from that point of view, once that happens, I think gold will again attract a lot of interest.
Okay. Thank you very much, Guy, for your time.
Thank you.
And we look forward to speaking to you next time.
Yes.